Good morning.
Morning. Very nice to be here. Thank you for the invitation. And a real pleasure to be here to have a conversation about the Microcap Trust. Are you going to put the slides on the?
Yep, here we go. Great. So I'll move the slides. But I think, as usual, the best thing is if you just sort of talk us through what the fund's trying to do first, please, and then we'll move to questions.
Okay. Well, I was just going to skim through. I know I've only got 15 minutes. I'm just going to sort of put a tiny bit of background on, which is that just to remind everyone, the UK stock market has underperformed for 30 years versus the mainstream market. In part, that's because they're very heavy capital-intensive businesses, not exclusively, but that includes, of course, mining and energy, which obviously is quite a bit high profile in the London market, but also quite a lot of other capital-intensive businesses are financials. They can obviously require a lot of capital. And the problem with a lot of capital-intensive businesses is as capital becomes cheaper and cheaper and cheaper, the ability of new competition to set up when you get a lucrative patch becomes easier and easier, and therefore it's been a long period where actually all those capital-intensive businesses haven't really risen a lot compared with a global stock market which has risen a lot. The net effect is that actually the UK market's underperformed. It produces lots of return, but it's underperformed. If you go back to say 2000, the market was something like 6.9. It's now about 7.4 in terms of the FTSE 100, and so it's hardly appreciated. It has produced a return going forward. If we move to the next slide. To the next slide. Yeah. During this period of underperformance, it's been undervalued and it's become progressively more undervalued. FOMO, the fear of missing out, which is often people talk about, in the case of the UK stock market, it's been fear of not getting out because people are making money elsewhere. So there's been a kind of race to get out of the UK stock market. Local investors have reduced their weightings. International investors have become completely disillusioned. And so we've seen the valuations move down to substantial discounts relative to the mainstream market. If we move to the next slide, James. And if anything, what's been interesting is that even as the UK stock market's recovered, and let's just remind ourselves, the good and growing income becomes more valuable when capital costs go up. Effectively, companies generating surplus cash start to have all the advantages. Companies generally, the whole effect of interest rate rises and inflation generally is that most people run out of money, most individuals, most corporates, most governments. And so it's been a period when companies generating surplus cash have started to outperform. We've seen that in the UK. The FTSE 100 is the best performing stock market pretty much around the world over the last 2.5 years. But even so, what we've seen locally is that people have said, oh, thank goodness for that. I can take some money out of the UK and I can put it into bonds, which now have a proper yield, or into cash, or perhaps buy back into some of the US assets, which have fallen back enormously. And so we've seen wall-to-wall selling really in the UK market. And that's been offset in the international markets by new investors coming into the UK stock market and saying, I wouldn't mind rebalancing from some high beta stocks, the volatile stocks, back to income generating stocks like in the UK. And so that's why the UK market's gone up. But in smaller companies, they've absolutely been shot to pieces. The AIM market's just hit a new low again. Having hit a low in October, it's hit an even lower low recently. So coming back to it, we're looking at a period where underperformance of the sector has led them to extraordinarily low values. You moved on, James, to the next one. The biggest problem really is going forward. I think, there's huge recovery potential for the UK stock market. There's huge recovery potential for the smaller end of the UK market. But the biggest question mark, I think, lies in how us as fund managers manage this transition. What you see, this is looking at profit margins across the US economy back from 1957. And you can see profit margins are typically high in low inflationary periods when debt's cheap and stuff. But what you see is when you put up inflation, when inflation comes and interest rates go up, then you do find that profit margins go down. They can recover to some degree. But what we saw in the 70s was, yes, we saw a couple of false starts, but ultimately profit margins across the US economy halved. And so we are making the assumption that over the next 10 or so years, perhaps global stock market profit margins will halve again. And the question is, how do you pick stocks which are able to offset that and can generate good returns? And that's most particularly often not just companies who are investing, not companies which happen to be, got a new product, but most particularly companies which deliver not good but outstanding levels of service. We are tremendously interested in companies which aren't just delivering good service, but delivering outstanding levels of service. And we engage in companies, and that's one of our principal objectives for selecting stocks. Doesn't mean you're completely resistant to margin compression, but it means that when customers come to you and say, we're going to go somewhere else because there's someone else charging less for the same service or the same product, You can say, well, you could do that, but actually you won't get the levels of service. And so you do get an opportunity to not just survive, but actually continue to thrive. And that's particularly the case when interest rates go up and companies start to go bust. If you move to the next slide, please, James. So what we're worried about is that, you know, the mainstream stock market may lose a lot of its momentum, upward momentum. What we saw in Japan when it peaked out in 1989 was as margins came down, as valuations came down to previous norms, you saw the Japanese stock market come down pretty hard. And although it's recovered somewhat since then, it's not really hit the same levels as it was in December 1989. So effectively, we could have a long period where mainstream assets produce very little return. And if that is the case, then investors are going to become horribly interested in those areas which can buck the economic trend. And the great advantage of you know, an unsettled world, I think a global recession is very likely going forward, is that as companies go bust, quoted companies generating surplus cash don't just survive, but they actually thrive. If you move to the next slide, James. So the opportunity isn't just for us to invest in quoted companies, which are very lowly valued at the moment, but it's for those quoted companies to make further acquisitions of viable businesses which are over borrowed prior to the downturn. And many of those businesses are private. Some of them are involved as subsidiaries, and some of them are sort of zombie companies and all the rest of it. And the great advantage of these companies is that they can buy these assets as low as £1. Now, clearly, it's not just £1, because you have to put working capital back in again. But to talk about the upside, the opportunity for investing in the smallest quoted companies, which have the advantage when things are unsettled, and the upside of acquisitions is demonstrated by the recent acquisition of Made.com by Next. So Made.com, as you remember, came to the stock market 4 or 5 years ago. It was valued at 500 million. It touched 775 million actually in the pandemic, selling its sofas. It went bust last year. It was bought by Next, not for £1, but £3.4 million. They probably had to put 25 million of working capital in. We don't quite know what the number is, but say it's a 30 million acquisition, and say it's not worth 500 or even 700, but say worth 330 million to make my maths easy. So they've added 300 million of uplift for 30 million investment. That is good business, and we want to get our companies involved in those kinds of acquisitions. Next happens to be 8.5 billion market cap, and 300 million makes a difference to 8.5 billion market cap, but only about 3 or 4% difference. The real excitement comes to investing in small companies in this environment. Small companies, say a tenth of the size of Next, say 850 million market cap, then you know, for 30 million you can get a 300 million pound uplift. Well, of course, that's 30 or 40% uplift. And as you move into the microcaps, the companies below 150 million market cap, if you were an 85 million pound company, for example, you don't have 30 million. You have to come and see funds like ourselves and some of you. But by doing so, you can raise capital, probably raise a bit more just to be safe, maybe 40 or 50. So you might have a company valued at 150 million market cap after it's raised money, bringing in an acquisition which adds 200 million, sorry, 300 million to the uplift. So basically a 200% uplift in value. For the first time in 30 years, I think it's an advantage to be a listed company because you've got a stronger balance sheet, but you've got the opportunity to raise capital, and you can actually thrive at a time when companies going bust. That is the opportunity for the UK microcap sector. Obviously, people worry, if you move to the next slide, James, that actually the nightmare is that actually during periods of recession, the UK economy can actually not do very well. We've got worse inflation. If you go back to the 70s, we had lots of strike action. The IMF had to come and rescue the UK in 1976. You know, we had 3-day weeks. Surely, why would you buy domestic earners when currency is so weak? And coming back to this is looking at what happened last time. Small caps have outperformed in the last 30 years, but so what? Everything's outperformed the UK stock market in the last 30 years. But coming back to that time, that dark blue line, the UK stock market was one of the best performing stock markets in the world. And so we're looking at a period really where the UK outperforms because it's generating surplus cash when cash is short. But those smaller companies, you can see there, the 850 million pound companies, the light blue line, didn't just make 76 times your money, you made 400 times your money over this 30-year period. And if you look at the microcaps, the 85 million pound companies, the green line, 1,100 times your money. So the opportunity for getting into a green line, which outperforms not just international stock markets, but the UK stock market as well, is tremendously exciting as far as we're concerned. So if you move to the next slide, the nature of the strategy, therefore, is to have funds focused on microcaps. An investment trust is a particularly suitable structure for this. We think when there's if there's an investment desert coming in the future with indices producing very little return, then there's only going to be various niches and seams of return. We think that a unitized vehicle which perhaps was investing in microcaps might find that there's too much institutional capital coming in. It gets too large to invest in the microcap sector. Again, a quoted investment trust is the way to restrict the supply of investors into the fund. Ultimately, microcaps have a period of tend to outperform, but we select for companies which are finishing a period of investment and entering this cash surplus phase afterwards. We think that means that once they generate cash surplus, even if you have a recession or a change of government or whatever, you're in a strong position. It's quite a long list. People think perhaps we can't make our mind up. No, that's completely the other way. There are quite a lot of 25 and 15 million pound companies out there with outstanding prospects, where if you had a longer list, if you had a short list, say this fund gets to 300 million in due course, we think it will expand in due course. If it got to say 300 million, that's for the directors to determine in due course. But if it did get to that stage, if you only had 50 holdings, then of course you'd be basically putting in 6 million in each holding, and you wouldn't be able to invest in the 15 million pound companies or the 25 million pound companies with the upside. So to invest in smallness, you need a long list. We have a real preference for companies which are resilient through difficult times. Share prices might go down, but they don't need new capital. So strong balance sheets very much favoured. And then the opportunity for add value. There's very few professional investors at this end of the market. The opportunity for adding value to that green line I showed you earlier is tremendous. So we've got a real upside potential as a result of that. The nightmare is, of course, nobody's interested in UK small caps at the moment. The institutions have been selling the OICs. The share prices are going down. And we've been there before. If you go back to 2019 in the May government, if you remember at that stage, there was real worries that Parliament would not agree an exit with the EU, and we would go into WTO, World Trade Organization, trading arrangements with the EU. So microcaps underperformed, this fund underperformed, and then we had the pandemic, it came down even further. But what was interesting, after it bottomed in March 2020, was the value of the NAV rose not quite threefold, between 2 and 3-fold after that. So when it comes right, it can come very, very right. I think that's a glimpse of what could happen in the future. Obviously, if you go to the next slide, James, what you can see at the moment is, of course, no one's interested. We see in the mainstream stock market holding up pretty well. As I say, pretty much the best performing stock market in the world. I think that's a pattern which will continue. I think the UK will continue to be one of the top performing markets. Most investors are underweight. Most investors, the valuations are unusually low. You can only get 10 or 20 years of outperformance of an industry sector or market if most investors start off in an underweight position and if the valuation starts off an ultra low valuation. But then, of course, the really cheap part of the UK market is quoted companies, small quoted companies, microcap quoted companies. Valuations are incredibly low at the moment. So we're looking for that turn, a bit like we saw in March 2020 for this market, for the fund, not just to outperform, but outperform handsomely. So going forward, if you look at the current performance, of course, it's very weak. It's relatively weak relative to the under small cap funds. It's relatively weak relative to even some of the indices, which tend to be dominated by the bigger end of their makeup. But most particularly, the companies themselves, we're tremendously happy with, and we can talk about that in a minute. But most particularly, we think the upside potential, when it comes, could be very substantial. And as I mentioned earlier on page, if we go to the next slide, James, the nature of the upside is when it comes is because most people are underweight and because the UK outperforms and most people want to hold an outperforming market and maybe alternative markets aren't making any money, you get into a virtuous spiral. That is what we anticipate. We think this virtual spiral may last, say, 10 or 20 years. We don't know this, how long it'll be. It started, as I say, probably about 2.5 years ago. Nobody's talked about it as yet. Of course, they haven't really noticed. Local investors are still selling, but international investors are offsetting the local selling. That's why UK's already started to go up. If we see any diminution in UK selling, local OIC selling, then I think the UK stock market will break out on the upside a bit like Japan. But most particularly, I think the duration and the scale of that outperformance may surprise on the upside. If you go to the next slide, this is a sort of relative performance chart between the all-share index and the S&P 500 index. Going back from 1965, most of us in our investment careers know about the green line. Low beta stocks, income shares, stable companies producing an income generally have been overlooked relative to the much faster growth companies of unicorns and cash consumptive companies in the US particularly. And so we've seen the all share massively underperform versus the S&P index for the last 30 years since the late 80s. And what we've seen now, of course, is the start of the UK starting to outperform. With inflation, it changes everything. As you can see, last time, we don't know if it's going to be quite the same this time, but last time the UK market didn't just keep up with the S&P, it massively outperformed. When everything's short of cash, the advantage of having cash surpluses is that you can not just survive, but thrive by buying acquisitions from the receiver. This is the mainstream stock market. Normally, when I've been seeing clients, I tend to talk about us outperforming the mainstream UK stock market, and that's fine, but everything outperforms the UK stock market in the last, say, 30 years. But going forward, if the UK stock market continues to be one of the best performers, and if this fund does have a catch-up period and starts to outperform versus the UK market, and I think it won't be just one catch-up period, I think hopefully there'll be a series of them in the future, then the UK market will be one of the best performing stock markets in the world. This will be one of the best performing parts of the UK stock market, hopefully one of the best performing added value through stock selection as well. So when you compare this perhaps with international strategies and other areas of investment, you find that this is a very rich seam of investment. We think that most of the competition will start to come down from the mid cap into the small cap, into the micro cap. I'm talking about some of the other small cap investors. And as that happens, you get new flows in, drip, 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 valuations are not falling, they start rising. And you get this period where these companies have increasing access to capital at a time when you can buy assets for distressed valuations. To conclude, the bottom line is, next slide, to conclude, the UK stock market is completely different from most other global stock markets. Cash compounding, capital intensive businesses have been popular during inflationary periods in the past. Quoted small caps, particularly quoted microcaps, have a history of outperforming the UK stock market. It has over the last 30 years, but so what, everything else has. But during inflationary periods, the advantages of being listed and the advantages of buying assets from the receiver enhance the opportunity to thrive rather than just survive. We believe that the fund itself, the trust, contrasts with others in a skew towards companies with strong balance sheets, but also companies generating cash surpluses. We're not trying to pick up the next Apple or whatever. We want companies, ordinary companies, generating plenty of cash surplus. To date, they've been very much depressed by local selling, UK OIC selling, very few buyers coming into the sector. So valuations of anything have gone, which were cheap before, even more attractive. And we're looking forward to a virtuous spiral, which we think has already started in the mainstream stocks, but we think that'll extend down to small companies, microcaps particularly. And when that happens, hopefully this fund will be a strong performer in future. With that, James, I'm very happy to answer any questions.
Great, thank you very much. It's rattling through quite a big topic there. Where should we start? I think firstly, there's quite a good question at the top of the Q&A actually, which is just sort of looking at the big picture. Do you think that the UK is a good place to grow a company? So maybe a good place to start a company, but is it a good place to scale a company up?
Absolutely. I mean, the whole point about the UK market is that it's not a big market. It's about 4% of the global market. It's used to be much, much bigger. It used to be 18, I think, in the past, or perhaps even bigger. But the point is, we still have a very viable universe of investors, and therefore you can raise capital. In terms of smallness, and I think, summarize, I think we've had too much bigness during globalization. I think most institutions need to embrace more smallness. The UK leads the world in its vibrancy in terms of, investors and advisors and the number of quoted companies in the smaller end of the market. I think the UK market can become the market leader in small quoted microcaps. And I think that's a terrific feature. As I said, there's a lot of mid-cap, small-cap investors who can bring their capital down into the smaller microcap sector, which I think they will, because that'll be the best performing part of the market. They'll underperform if they don't. So absolutely, I think cost of capital, which is ridiculously high at the moment, needs to be improved. But I think once you get the favourable trend, you get into this virtuous spiral and the cost of capital comes down considerably over time.
How much of an issue was Brexit on all of this sentiment towards the UK and what happened with microcaps?
I think it was just another sort of kick in the shins, really. I think what happened is I don't think it's made a huge difference to the growth of the UK economy. It may have added a bit to inflation along the way. But ultimately, I think most investors were fairly bored with the UK before Brexit, and Brexit gave them another reason to sell, reduce their weightings further. I think the uncertainty about further agreements and Brexit going in the future has probably added a little bit to that. So I think trust probably added a negative. I think if you wanted to sell the UK market, you've had every possible excuse to sell the UK market. And that's why I think international investors are so lowly weighted. Even domestic investors, which used to have very substantial weightings in their clients' portfolios, have reduced UK weightings often to very low levels. And that's, as I say, a pre-requirement of a market which is going to outperform for a decade or two. So I think it's been an unhelpful issue. I don't think it's affected the progress of companies very much. I think that most of them are navigating perfectly happily, but I think it has affected sentiment in a major way, yes.
With returns on cash and gilts and things being higher, you already talked about people selling stuff to buy bonds. Do you think there's still a bit of that to go before people really embrace equities?
Maybe. What I would say is I think inflation will drop away later this year and early to next year. So I think inflation will peak out, and we may even, if we don't cut interest rates, get deflation and possibly depression. I don't think it's very likely, but it's possible in the US. Certainly, if you look at M2 at the moment, it's falling at the fastest rate. M2 is a sort of measure of money supply in the US. It's falling at the fastest rate since the Great Depression, falling faster than it did in the 70s, for example. So we have got some downside risk there, but it doesn't matter whether it's deflation or inflation. Companies generating cash surpluses will have the advantage. I think when we find a recession coming through, and I think it may arrive quicker than people think and be more adverse than most people think. If that is the case, then I think you may find bond valuations, people like bond valuations, they kind of, it's a safety place. But ultimately, all that happens is the governments just throw money at the problem again, and we just get another cycle of inflation. The nightmare, really, with fixed income is that it's fixed income at a time when inflation may be persistent. Ultimately, yes, it can be a good refuge on a tactical basis. It can be a good place to diversify risk. But ultimately, you need to invest in quoted companies if you really want to offset the risk of inflation. So I'm not saying it's all over. I think it could be that, as I say, bonds attract ongoing interest for a while yet. But I don't think it's a very satisfactory long-term solution for even institutional investors to access a return, particularly if we're entering an investment desert where many of the mainstream stock markets don't go much.
Okay, thank you. So a few sort of questions about how the fund's put together now. Firstly, how do you factor valuation into whether you think things are a good investment or not? How do you sort of measure?
Yeah, I mean, Martin and I, Martin Turner and myself, we managed the fund since we set it up in 2015. The bottom line is we are very mean in terms of valuation. We really don't want to pay up. The great advantage about this end of the market is there are a lot of companies which are very overlooked. And so you can buy companies not just cheap, but really at stunningly low valuations. And what are we measuring? We want companies which are going to generate surplus cash. So these are companies, as I say, which are finishing an investment phase, often looking for the cash return on that investment phase. So ultimately, what we're looking for is companies which are going to generate substantial amounts of cash relative to their current market cap. That is probably the key ratio. To do so, you do need sales. So early stage companies, unless they're about to get very substantial sales, aren't very interesting to us. In that, we look for companies which have strong balance sheets. So even if they don't hit their early targets, yes, the share prices might go down. But if they don't need additional capital, then you've got the full recovery of the share price and the long-term potential, which we sought originally. So those are key factors in our valuation. But the key, as I mentioned before, is that we're looking for companies which are on low valuations, because you can buy some very good companies with some slightly more forward-looking valuations where perhaps people are excited already, and they can go on to succeed and generate lots of return. But the greatest upside comes from the overlooked companies. And the great advantage of microcaps is as they get larger, over 150 million market cap, over 250 million market cap, then as they get into a universe where perhaps a lot of other small cap fund managers start to look at them, then you find that actually they tend to get a valuation enhancement at that stage because more investors start to get involved. And you get this kind of period where people say, I can't believe it. This is a marvelous company. How come we didn't know anything about it? And so it gets easier and easier to sell microcaps at higher and higher valuations as they move into the sort of broader small cap investment universe. So you've got the opportunity of buying really overlooked companies, very overlooked at the current share prices. But when the upside comes, the option value sort of built into these companies is often not just 30 or 50% upside, but a number of multiples on the original entry price. And so coming back to it, to summarize, we're fairly mean at the entry prices. We don't want to pay much for our market caps, but when they succeed, they can often move up to much higher valuations, and there's plenty of buyers for us to sell to.
And then how do you manage position sizes? So do they all go in at sort of equal weights?
Yeah, it's not quite, but that's not far away from it. A company, we can get a company wrong, even with high conviction. So we tend to buy sometimes 1.5% holdings if we've got a high conviction, and we manage that. So a lot of the holdings are relatively small, as you said. It's up to 140 holdings. So clearly that would be on average a 0.75% holding, or perhaps 0.7% holding. So quite small holdings. Two reasons. One, that means we can invest in these really tiny companies, 15 and 25 million market caps. Sometimes some people say they cut off at, say, 100 million market cap in some institutions, and some stocks become just literally too cheap for them to buy because the market cap's below 100, and they say, oh, I better not buy that because it's too small. And what they mean is there's too much upside. Ludicrous. The thinking is not good. So coming back to it, we absolutely can buy the 25s and the 15 million market caps because we have a long list of holdings. But what tends to happen is that we tend to take tops on our holdings. We look for things to peak out in terms of, we need sales growth. So if sales growth starts to slow, that's a sell discipline. We find margin pressure. That's another thing. It's all very well getting sales growth, but if you've got margin pressure, not generating cash surpluses as much as we might like. If we meet quite a lot of management teams who start to get more overconfident when the share price goes up and they start taking more risk, we're not interested in that. We look for companies where the balance sheet is relatively safe. If they start to do deals, perhaps with more debt, then you find that, of course, the balance sheet becomes more risky. And if they miss their targets, the downside is more significant. So again, that's another reason for us to sell. And then the last point is that we tend to trim on companies where they're expensive. So those are our 5 sell disciplines. Coming back to it, we have the largest holding in the portfolio at the moment is U Group. To be honest, it's 5% of the fund. That's an enormous percentage for us, right? To be fair, it has moved up nearly 5-fold since we bought it about 2.5 years ago. It's an exception in the small cap market, and because it's actually risen when most other small caps have fallen. It's involved in utilities. It's a utility supplier to the corporate sector. Specifically, it's a company which had 18 million of cash at the end of last year, end of December 2022. The Liberum note, which has just come out, it had a 42% upgrade recently with strong trading. But the Liberum note suggests that they'll have something like just under 70 million in their balance sheet at the end of 2025. The market cap has moved up to 100, to be fair, but it's just ludicrously undervalued, even at that valuation. So we still haven't got any of our red lights on. And right now, because we haven't got much correlation with that holding, we're allowing that holding to get bigger. But it is probably the exception rather than the rule that holdings get to that kind of scale.
And then if something sort of goes rattling up, I mean, is there sort of a market cap cutoff where you go, it's too big for the fund now?
No. If there's a very strong reason to hold the company and say it does an acquisition, does become a lot larger, maybe. If the risk reward ratio is attractive, and if the valuation still hasn't reflected the upside, then the fund can continue to hold. There's no automatic sell disciplines. What we want, of course, is a wide range of different risks. We don't want them all to be correlated to the same event. When you get an unexpected event in the future, Ukrainian invasion, pandemic, you want some companies which unfortunately may be affected in an adverse way, but you want some other companies which have a chance of not just being adversely affected, but actually being positively affected by such a change. So coming back to it, we want a long list of wide-ranging holdings. Specifically, therefore, we can hold companies like some of the energy companies, which do become market caps over 150 million, which is the sort of normal limit of 150 million market cap, sort of microcap.
Okay. Sector-wise, what's the sort of distribution of the fund?
So it's interesting, actually, because although technology is clearly an important factor of that, and we do get quite a few fallen angels at the bottom of the market, we are so interested in cash, and most particularly physical assets at the moment are standing at very low valuations. I'm talking about miners, I'm talking about energy companies, some financials, that actually there's quite large weightings in those sectors as well. So when you look at the sectors at the moment, the largest weighting in the sector, just under 17% of the fund is invested in materials. These are miners typically. These companies are generating surplus cash. They're a sector which most active fund managers absolutely hate. They don't know what the price of, platinum is going to be on the future, or gold, or that kind of thing. specifically, that's not, I don't know better than everyone else, but what I do know is they're not always correlated to the economic cycle. We saw in 2020, gold price initially dipped in 2020, March 2020 with the pandemic, but then it rallied as money was thrown at the problem. And so you can get sectors which during recessions can really thrive in the mining sector. And we like that. So the largest holding in the mining sector at the moment is a company called Andrada. Andrada is a tin miner in Namibia. It restarted a tin mine. It's generating quite a lot of sales from that, and it's investing hard because actually it's found alongside the tin, it's got a lot of lithium, which has started to export, and there's huge interest from companies to buy the lithium from them because there's a shortage of global lithium miners at the moment. So again, the share price has come up. It's bucked the trend in terms of microcaps. It's about 4% of the fund, but again, it's that surplus cash. Coming into the second largest sector, information technology. So there we are. Technology is not a surprise. There are opportunities of companies which are overlooked. MTI Wireless is the largest company in the information technology company. It makes aerials. It's been trying to break into the global tier one suppliers for aerials for modern telecoms and all the rest of it. As you probably know, with as you get more and more sophisticated and more data down these microwave beams, they get smaller and narrower. And as a result of that, when you've got two microwaves aerial to aerial across the UK or something, they get more affected by the density of the air. That distorts the direction of the beam, and so you actually find that you have to move the aerial to keep it on target. That's obviously a process which is prone to failure. MTI Wireless have a patented solution, which is they don't move the aerial, keep the aerial fixed to the mast, but they move a little bit in the middle, much more accurate. They're breaking into the world market on the back of this. Very exciting. Cash generative company, a profitable company, net cash on the balance sheet, etc. So again, just the kind of thing we look. Cyan Canode is another example. I won't go through all the examples, but there's plenty of examples there. The third largest is actually industrials. We don't have many cyclicals in the sector, but we've got Shore Servers. It's a construction business which has been obviously been taken over at the moment. We've got Braemar, which is a shipbroking business. Again, a very strong market position, rallying fast. The third largest is DX Holdings, which just had results recently. Again, it's made an acquisition from the receiver of a lot of Tucknell's web sites. Probably added, if they could bring all the business across, that's probably added 50% to their sales. They probably won't bring all their customers across, so maybe it'll be 30 or something like that. But again, marginal, investment for quick cash payback. Energy is the fourth largest. We believe, although energy prices are going down now because of the problems with global recessions, we think that we've underinvesting in carbon-based energy specifically. Don't get me wrong, I'm interested in reducing carbon. I'm very interested in long-term, more wind turbines and the rest of it. But I think we're just mismanaging that at the moment. So we've got Zephyr in there, we've got Kistos, we've got that kind of thing. So coming back to it, the sectors themselves, they're quite a wide range of companies. Really, there's a large number of different risks in there. So I'd probably emphasize that even within sectors, there's a lot of diversification.
Great. Okay, that's helpful. Now, is it true you've got about sort of 10% of the fund in cash at the moment?
It's not quite 10%, but we do have a lot of cash, and that's not
being held back to pick up bargains as they sort of appear, or
yes, there's two things.
When's the right time to deploy that?
We don't know. What we do know is that while share price is going down, there's no point in pretending that can buy today and they'll go up tomorrow. That doesn't mean we should avoid holding in companies, and we do back companies. We do have, as you say, a substantial amount of cash. It's about 9%, rather than 10% at the moment, but not far off 10%, as you say. But the great advantage is that we can put that capital in very quickly. What is disadvantageous is if we found that a global recession came, let's exaggerate and say that it caught most people, investors out, and there was a stock market reset downwards, then you might find that actually selling companies may be pretty tough. So let's just have the cash ready. We can put it in very quickly. Selling it takes a bit longer. So therefore, the fund is deliberately running too much cash at the moment. We can support companies doing transformational acquisitions. We can top up some of the existing holdings after they bottomed at ultra low valuations. And most particularly, we can enhance the upside through backing new decisions. The old company comes to us, which we don't hold, which is going to make a transformational acquisition, and we'd love to back those holdings too. So we don't want to be selling some of our existing holdings to do that. Hence, we've got the cash there ready to do it.
Okay, thank you. Do you have some unquoted in the portfolio?
No.
No, I didn't think you did.
We can make huge amounts of money without bothering with unquoted. Why would we bother with unquoted? They just have to spend 15 minutes talking about them and whether they're being valued correctly, etc., etc. So much easier just to make plenty of money and ignore the unquoted entirely.
Yeah, fair enough. I think that I understand that. What about turnover? How much is that of that's going on?
Yeah, I mean, the great advantage of having a long list is that we can sell our losers, and we do. Clearly, we don't always sell them at great prices. We sell them at lower prices often than we purchase them at. But the point is, we got the cash back, and we're not involved in the emergency fundraising, etc., which comes after we've sold them. So we're not shy about knocking companies out if we get them wrong. Clearly, some of our companies succeed, and they go too large, and perhaps valuations move up, and perhaps some of those red lights come on I told you about, so we sell them for that reason. So there's quite a lot of opportunity to buy and sell in the fund, and most days, there's something going on. We're trying to add something here, we're getting involved in a transaction there, we're taking some profits on perhaps one of another holding, perhaps where we've got to overlap with another company in the portfolio. So coming back to it, there's a lot of little turnover, but in terms of sort of big turnover changes, the portfolio doesn't change that much. A lot of holdings are there for many years. Specifically, we do find generally there's more sell signals that come before global recession. And so we have seen the number of holdings coming down as we've started to sell holdings where the red lights come on. That's where the cash has come from. So we find the portfolio tends to narrow a bit during periods of recession or ahead of recessions. Interestingly, of course, after recession, when there's more green lights on, then you find the portfolio widens a bit. But coming back to the portfolio, you do find that turnover tends to spike a little bit going into recessions and coming out of recessions. Even then, it's not very large. But I don't know what the exact number is. I'm not actually quoting the exact number in terms of turnover, but we're not trading holdings for 1 or 2 months or even 1 or 2 quarters. A lot of our holdings are in there for the long term.
And how do you manage the liquidity in these things?
Well, a great advantage of many of these companies is they actually have better liquidity than people realize. And that's because there's a lot of private investors who are, buying and selling the stocks. And the great advantage about private investors is that they buy small amounts, but there's lots of them. And so actually, okay, that liquidity tends to be particularly significant during times of results, perhaps announcements, acquisitions, that kind of thing. Maybe there's less liquidity at other times. But the point is, there's liquidity. And these holdings are relatively small in absolute terms. Therefore, the opportunity for getting rid of them or adding to them is relatively easy. That's the great advantage of a long list of portfolios. So basically, we like to optimize our dealing, but most particularly, liquidity isn't really a big constraint for this fund, despite its microcap bias.
Do you have a limit on the amount of an individual company that you can own?
Yes, we do. And we obviously run a unitized vehicle as well. So we do overlap with other companies, other strategies in Premier Miton Stable. But coming back to that, I mean, the problem with fund managers, and there's lots of problems with fund managers, but one of the problems with fund managers is we can become overconfident and particularly overexcited about individual stocks. And for that reason, you really want to be quite highlight to the fund managers when they are getting a bit overexcited. And so, our clients can buy up to 15% into an individual company. If we want to go beyond 15%, 16 or 17%, you tend to find the system will give you a little warning to say you are going into 17%. Are you quite sure it's the right thing for your clients to buy 17% of this company? And of course, a lot of fund managers say, yes, of course, I'm sure, that's why I'm doing it, sort of thing. But when you get to 20%, there's a hard limit. And you have to go, if you want to go for 20%, you have to start writing internal reports to the risk department, to the compliance department as to why it's in your client's interest. Not many fund managers want to do that. And so strangely enough, not many of our holdings go over 20%. And so you can, if it's the right thing to do for your clients, but it has to be an exception basis only. So coming back to it, that tends to restrict our ability to buy too much of an individual company. Coming back to the factor that, in terms of, people think, the problem with a lot of these small companies is they don't have very strong kind of, climate change agenda teams, and and they're not very responsive to the climate change agenda. That is just so wrong. You know, when you compare it with mainstream stock markets, where most mainstream fund managers have 0.1% of Shell or whatever, you know, they really don't have much leverage on the management team in terms of their views. As you move down the market cap range, the opportunity for us to engage with these management teams, albeit they have small, you know, climate change teams or teams to do with governance or social responsibility, all of those things, but the opportunity for us to engage and say, in our view, you should actually put a bit of attention to this, or you should think about improving your carbon, emissions, that kind of thing. It's actually much more significant at the smaller end, the microcap end. So actually, coming back to it, the fact that we have 3, 5, 10% of these companies means that actually ultimately, if anything, they're more responsive to our engagement than the very big companies. Again, very counterintuitive, very exciting for the future, overlooked at the moment.
Fair enough. Can we assume that you've got a stake in the fund?
Yes, you can absolutely say. I mean, basically, I don't buy any other funds except my own funds. I've got a nice holding in Mini, and I think it's a really, you know, I think, you know, the opportunity for the fund in the future is really quite exciting. So this, you know, the Gervais and the other funds I'm managing, Martin, I have holdings in all of them. The only other significant asset apart from my home I have is a holding in Premier Miton Fund.
Fair enough. Do you have a favourite of the ones? They mean.
I mean, it's a bit like your children, isn't it? Do you have a favourite child? It's a bit, there are certain features about Gervais which I absolutely love: the income and the income growth and the resilience and the, you know, all of that kind of stuff. Obviously, what I love about Mini, and the reason we set it up with Martin, was because we can support very small companies to make transformational acquisitions, and that's wonderful for their staff. It's wonderful for their businesses. It's wonderful for the UK economy in terms of generating more skilled employment and ultimately more productivity improvement, which means we can fund wage rises, which are better than most of the mainstream inflationary. So, you know, again, on a sustainable basis, ultimately it generates more tax. You know, I love Mini. I love Divvy, but I love Mini too, to be honest. And I love it when it goes up a long way, of course, not because it goes up a long way, but because my clients do well.
Great, thank you. And one last thing, just on the discount. So it's relatively tight at the moment.
About 4%, yeah.
Yeah. How is that managed by the board?
So just coming back to that, I mean, what we particularly do is we want to make sure that anyone who wants to get out can get out. That's obviously you can do by buying, selling stocks in the market in the normal way, cash. But what we also do, which is very unusual, is we offer all investors, including institutional investors, an unlimited exit each year. Now that sounds very counterintuitive. If you offer everyone 100% exit, why don't they all go? Well, they can do, but then they know when they tick the box, they're going to be exiting, as opposed to kind of like sometimes there's a tender for 15%. You tick the box, you're not sure how many you're going to sell, whether you're going to sell some or all. And so you tend to kind of overplay those things. If you tick the box, you know you're going to deal in 100%, then you're careful about ticking the box, particularly when it has the risk reward ratio that this kind of strategy has. So coming back to it, we offer all investors, at the board's discretion, the offer to redeem each year. And because of that, we don't tend to have any significant overhanging sellers. And as there's very few significant overhanging sellers, it means that people who are thinking about buying aren't put off by potentially overhanging sellers. And so you tend to find there's a bit more turnover into the stock. And therefore, in contrast to most of the other investment trusts in the sector, the discount remains much, much tighter. Okay, it's a discount, but it's not big. And clearly it can be a premium when we expect, you know, it's outperforming clearly. When it's rising rapidly, it moves to a premium. So mainly the share price fully reflects, hopefully, the NAV. That's what we're trying to achieve through this unusual redemption mechanism.
Great. Well, thanks very much for that. We've
probably would add a couple of things, James, just to comment on that. It's unusual, but particularly the fund has a put option, doesn't always have a put option. What is that? It's a bit like a sort of out of the money insurance. If the stock market were to fall to 6,000 or something, then I think it's 5.9, I think the put option comes in. Then clearly, you know, we'd be looking at a sort of meltdown, a global stock market meltdown. You know, we don't know when they're going to come. We didn't know one was going to happen in 2020, but it had one at that stage. And the advantage of that is that as the stock market goes down, volatility goes up, the value of put option isn't just on the level of the put option, I think it was 6.1 in that case, but also on the duration. So there was an asset which was only covering 25% of the assets, but rose to 5 or 4 or 5, 6, I can't remember what it was, some percentage of the fund, which we were then able to cash out. So one, it sort of slows the downside, doesn't stop the downside, just slows the downside, but most particularly it brings cash in through selling the option when the markets collapsed, and therefore we have more upside potential. So we haven't had one sort of since March 2020 for about a year and a half. We've had one over the last couple of years. It's cost us money because FTSE's not gone down. We've not had a global stock market crash. It tends to cost around 1% a year. It's covering about 40% of the fund at the moment. But if there was a stock market crash, obviously we don't know if there's going to be one. Let's hope there isn't. I don't think the UK would be immune. Everything goes down, then it's there for the extreme rainy day. So that's the first point. It's there through to December 2023 at the moment. It's not worth very much, but it could be worth quite a lot if we got a stock market crash. The other thing worth mentioning is that actually the fund itself has the ability to scale up over time. We believe that very few institutions have any weighting at the bottom there in the market. It is a small fund at the moment. But what is amazing and quite counterintuitive about the fund is, in spite of being far too small for most wealth managers, the very largest wealth managers are involved and very supportive of the strategy. And that's partly because we have this unlimited redemption opportunity each year. And so they don't have any anxiety about getting out of the fund if they need to change their mind for their clients. And again, that means that it's not just well positioned now, but it could scale up considerably. It's never going to be very big. I don't know what the directors will believe the right size is, but say 300 million. It's never going to be 1 billion in my view. But most particularly, it may become a much more significant fund in due course as a result of that.
Okay, thank you very much. Good stuff. So I will follow with interest what happens next, but it does sound like it's now's not a bad time to be looking at this.
No, we're pretty excited. Yeah.
So we'll get you back on again in a year or so and see how things have gone. But
thanks,
in the meantime, thank you very much.
Thanks for the invitation, James. Really a pleasure. And thanks for the questions, by the way. Really appreciate those too.
Cool. We'll be back next week talking to the manager of QuotedData Digital, which is obviously one of the things that's gone out to a big discount in the infrastructure sector. But we'll also have Andrew Mahati on talking about what's happened over the course of June. And then, as I've said before, we've got a full lineup of managers all the way through to September. So thanks very much for tuning in today and have a good weekend. And we shall see you next week. Bye-bye.